Evening all, it's Jim here at TutorD and welcome to our live revision session for the BTEC National Business Unit 3 coming up tomorrow, and this is a chance to spend about 35, 40, 45 minutes, hopefully no longer than that, doing some gentle revision on the business finance topics. We've already done, this time 3 or 4 months ago, a couple of long sessions on personal finance and business finance. So personal finance, if you want to do some quick revision on that, I'd suggest you go find that video on YouTube. And it's about an hour long, and we did about an hour and 30 as it turned out on business finance last time. So what I thought we'd do today is a shorter session, but I've written completely new questions with some new activities too. So if you really want some extra revision, again, those videos are available. And a warm welcome to everybody who is joining us live in the live chat. As you can see, we've got some quite big numbers tonight, over 500 so far, and growing. So this could make it quite interesting for me to try and work out what the answers are in live chat, but also what the questions are as we go. So maybe if you can help me out here by maybe just answering in the live chat as and when you've got an answer, and if you've got a question, which is great, we'll try to pick them up as we go. Maybe not post it in every 20 seconds, just so that it keeps the live chat nice and clear. Hopefully everyone's okay, and tonight not feeling too bad about tomorrow. I think the key thing is just to get into the exam, do your best, have a go at all the questions, and see what will be, isn't it? Hopefully tonight you'll find useful. I see Graham is also in the building. He's like the VAR of the live chat, so don't get on the wrong side of Graham. He is, no, he's great actually, isn't he? So great to see you. Anyway, should we get going? The basic idea here is we've got, I think, about 7 or 8 different activities where we cover a variety of topics from business finance, including some calculations. So you might want to get hold of your smartphone or your calculator that you're going to use tomorrow, but not all calculations. Some of it will be some sort of answer questions, asking you to respond to some different questions. I mean, that's the whole idea, isn't it? So why don't we get going and see how we do? And as I said, don't forget this session is recorded as well. So if you want to dip in and out of it as we go, no problem at all. I won't mind at all. Let's get going. Here we go. He says, pressing the right button. Hopefully, there we go. Oh, now on this one, I'm going to make sure I appear in the top left-hand corner, just so that I can see what you're doing and you can see me as well. Maybe it's to prove it's live. So here's a categorize activity. I know what you're thinking, Jim. Let's do a categorize activity. So in the live chat there, if you could maybe type in profitability, if you can identify the numbers, 8 ratios listed there, which are the profitability ratios, which are the liquidity ratios of the ones listed, and which are the efficiency ratios. So with most of these activities, we've got some funky or spooky or scary music to play along. So why don't we start the clock on this first activity and have a go. There we go. That's the first lot of scary music and 60 seconds for our activities. We've got a few of these sort of timed activities as we go. So how do we get on? Let's maybe check your answers. Saw loads of answers coming in, and quite a few 100% correct ones as well. There we go. So here are what I think is the correct categorization of those 8. Now there is one missing, which I'll ask you about in a second. 4 profitability ratios. Markup, I think somebody in the live chat said markup was liquidity ratio, but it's not. It's definitely a profitability ratio, as we will see in a short while. Gross profit margin and net profit margin, and also return on capital employed. And now don't forget, with profitability ratios, we need to make sure we include the percentage sign at the end of any calculations we do, because profitability is by reference to the sales or the capital employed of a business. It's a fraction expressed as a percentage. liquidity ratios, the current ratio and the liquidity ratio. A bonus question here in the live chat. What's the difference between current ratio and liquidity ratio? Maybe if you could just quickly type that into the live chat. What is the difference between the current ratio and the liquid capital ratio? I'll throw in a few of these supplementary extra questions to see who is quickest on the live chat, who's on the ball here, who's ready for tomorrow if it came up. Domi and Gurit and Barty and many others. I think those were the first three I've seen. Yeah, in the liquid capital ratio, we exclude inventory. We don't include inventory. And the reason for that is that in some businesses, inventory is quite hard to turn into cash. Therefore, it's less. The business is really less liquid if lots of its current assets are inventory. So there we go. That's excellent. The efficiency ratios there, trade payables and trade receivables days. So therefore, what is missing? There is an efficiency ratio missing. So what do we think it is? Again, in the live chat, if you want to have a contribution today, what is the missing efficiency ratio? There are 3 that we need to be able to calculate, and I only had space for 8, so therefore I had to miss one out. And Shivan, I think, was first on that one. Inventory turnover. Superb stuff. Okay, so we get the idea. We're up and running, and I know what you're saying. Jim, please can we have a game of business finance spinner? And you asked for it. I'm going to give it to you. So this is a very simple activity. We're going to spin a wheel. Why don't we even get the wheel set? First time we've done this, I think, for our BTEC Unit 3 sessions. I've listed 6 parts of a statement of financial position, or 6 types of income and expenditure, a mixture there, and all I want you to do is to give me an example of something which comes up when I spin the wheel. So I'll wait for somebody to say, Jim, spin the wheel in the live chat, and then I'll set the wheel off. Tony's asking, what the hell is this game? Well, you'll see in a minute if somebody says, Jim, spin the wheel. Jim, spin it. Spin it. Exclamation mark. Okay, let's spin it. Here it goes. Now, don't forget, this is as much fun for me as it is for you. I've no idea where it's going to land. It's entirely random. And please, can you give me an example of items that would be classified as capital income? So in the live chat, let's see what we've got. Emily, you're a bit behind there, unless you're on a very slow internet connection. I've just spun the wheel. But what I now need to do is to give me an example or examples of capital income. What do you think? So loans and loans coming in from the bank. The owner's capital, says Avia. Another loan coming in. A couple of people saying loans. Yeah, it's good. Income coming in from mortgage. That's the cash coming in from the mortgage. Income coming in from the issue of debentures. Superb stuff. Yeah, liking that. Liking that. Owner's capital. Williams come up with owner's capital again. What do we think? Let's have a look. I came up with a couple of examples, and you've picked them up in the live chat as well. So yeah, the owner's capital invested in the business. That's typical what we mean by capital income, isn't it? It's not revenue, it's income going into the business to help finance the business. So too is money received from a bank loan. Great examples. As Graham has mentioned in the live chat, I think he's blown away by those examples. I think Graham's thinking, Jim, please can we play the business finance spinner again? And that's what we're going to do. So here we go again. Let's put our 6 categories there. Now it might be capital income again, in which case this will be a very short activity. What do we think it's going to land on? What would you like it to land on? What do you think? Lucy, will this be uploaded after? Absolutely. A complete recording of this is available instantly as soon as the session finishes. Fabertron is saying, Jim, please can we play with the spinny thing again? Okay, let's spin the wheel. And where it lands, round and round it goes. Where it lands, nobody knows. This time it's going to... Oh, I thought it was going to be capital income again, which would have made it really easy. So this time, please... Examples of intangible non-current assets. What have we got? Intangible non-current assets. Ryan, yes, it is straight in with goodwill. Fantastic. I think that's the answer rather than the comments about this session. Olivia's saying goodwill as well. So intangible, things that aren't tangible, as the name suggests. They're not physical, but they have value, and therefore they can appear, if you've bought them, on the statement of financial position. Yeah, brand names. Arnold's got brand names. Brittany's saying brand names, logos, goodwill again. Trademark. Great to answer from Anna there. Trademarks. toxic YouTuber, which is a slightly worrying YouTube name to have, but each to his own. Sleepy Expo has gone goodwill, patents and trademarks. Wow, fantastic. There we go. There's my 3 examples. I could have added goodwill to that, of course. I've just put 3 there. Brand names, patents and trademarks. Yeah, superb stuff. Right, well done. Well, that's it. That's it for our game of the spinny wheel thing. Unless you want to play those 2 again, I think we have to move on. And this time we've got a new activity called the Data Lab. So it's time to analyze some data. I've got a couple of these. What I'm going to do is show you some data both in a table actually and an activity to have a go at. Shall we have a look at the first one? Okay, what have we got in the Data Lab to start with here? And we're given a table of some information for 3 businesses. Yeah, I can count 3 businesses: Business A, Business B, and Business C. Somebody's saying, I like his hair. I'm presuming that refers to the character there rather than me. More on that later. We're told information about the business's revenues and their gross profit margin. Anyway, over to you. You've got a minute to do this. Identify which business made the highest gross profit this year. Have a go. Maybe if you've identified the business, type in how much gross profit was made by the business that made the highest gross profit. There we go. I was waiting for the music to finish. It's amazing, isn't it, how quickly that minute goes. Next time, I think I'll give you 60 seconds instead. Somebody have asked me what shampoo do I use. I'm not sure why, but anyway, I used to use a thing called Wash and Go, but now I just use Go. So what most people, I think I've got the answer in. Most people are correctly identifying the answer, which is, well, if you work them all out, you probably didn't need to work them all out, but anyway, it is Business A. So well done. Lots of people put Business A, £168,000. So it's a good example, isn't it, of how a business can maybe have lower revenue. So on the face of it, not as successful as maybe 2 competitors, but if it's got a higher gross profit margin, it can make a higher gross profit in total, even on lower revenue. So gross profit margin is really important. It's the percentage gross profit you make on each pound of sales. So a business that makes £100 of sales, Business A will be making £60 of gross profit. So it was Business A. Well done. And as Graham says, often a high gross profit margin is an indication of better control of cost of sales. Let's do one more of these. I know what you're thinking, Jim. I love the Data Lab so much. I want to do another one, please. This time we're going to look at cash flow forecasting. So your challenge here is to tell me what the closing balance of that cash flow forecast is at the end of June. Here we go. There we go. It's not long, is it? A minute. You get a bit more time than this for this type of question, maybe completing a cash flow forecast. And it's a classic question. And somebody's asked, how do you calculate the closing balance? Well, we'll be able to demonstrate that by looking at the answer to this. Lots of people correctly in the live chat have said that the answer is closing balance is £25,000 at the end of June. And we had to work out sort of 2 or 3 stages there, don't we? There's almost 4 stages here. The first stage is to work out the net cash flow in May. So don't forget, net cash flow is inflows, take away outflows in a particular period. So in this case, £19,000. Our sales were higher, our inflows were higher than our outflows. £19,000, well, that's good. That's a net cash flow for May, but we started with minus £26,000. Just before we go on to the closing balance, what does that mean, that minus £26,000 mean? What does that opening balance tell you about the position at the start of May? Yeah, it's a bank overdraft. Actually, yes, I've just noticed the typo on June. Net cash flow 32. It should say 30, isn't it? I've made a change and not flowed it through the cash flow forecast. So I'll go back. I will adjust that. So the closing balance is actually it's going to be minus 7 plus 30,000, isn't it? Plus 30,000. So 23,000. 23,000. Good stuff. I'll correct that typo on the download. Now we're going to go on to an activity here called Impossible 5. This isn't a calculation question, but this tests your understanding of a variety of ratios and other key topics in business finance. So what I'm going to do is I'm going to show you, we'll do 2 of these. I'm going to show you 9 possible answers to a question, but the first, only see the first part of the question. So you don't see the whole question. Now, with the first part of the question, you'll be able to eliminate what we call the Impossible 5. These are the 5 answers that can't be correct. Yeah, so that only leaves 4 that could be correct, and then I'll show you part B of the question, and then you hopefully better work out which of the remaining 4 is correct. If you see what I mean, should we give it a try? It's probably easier to play than it is to explain. So let's have a look. So here's part 1 for this question. This current asset ... Now I'm not going to tell you what the last part of the question is, but from that first part, can you eliminate the 5 that can't be correct? Are impossible, the impossible 5. So either type them in or the grid references. Maybe you might say, I don't know, B2 or A1 or whatever. What do we think? So we're told that it's this current asset, but we're not told the rest of the clue or the question. But we can eliminate the impossible 5 here. Which are they? Which are the ones that we can eliminate? Which can't be correct? What do we think? Alina said bank overdraft. That can't be correct. Graham is saying bank overdraft. That can't be correct. Talia is saying C1, trade payables. Bronwyn's saying C1, C3 and 1A. C1, trade payables. C3, inventory and 1A, A1, bank overdraft. What else have we got here? Shanjit is saying accruals. That can't be correct. Olivia's saying C3. Okay. Should we have a look? This is identified a little bit of confusion about 1 or 2 of these terms, so that's good. That's why we're revising these. So there we go. Those are the 5 that can't be correct because the bank overdraft, accruals, trade payables, retained profit, and capital employed are not current assets. They can't be correct. So we're left with 4 that could be. So here is the final clue. It's the value of money owed to a business by customers who buy on credit. So which of the 4 that could be correct is correct? Which one of this is it? Is it A2, B2, C3 or A3? Somebody's asking what is an accrual. So Elliot, I will explain what that is in a second. We'll just finish off this last part of this activity. Alexandra's straight in there with B2, definitely correct apparently. Brittany also saying, Brittany and Harvey and lots of others are saying B2. Let's have a look, see whether you're right. It is indeed, yeah, well done, B2. Yeah, trade receivables, that is a current asset in the statement of financial position, and it's the amount of money that's owed to the business, owed to us, from customers who we allow to pay on credit. So they take their time to pay, but hopefully they pay eventually. And of course, that's linked to the trade receivables days efficiency ratio. How long on average do our customers take to pay us? It was asked in the live chat, what is an accrual? An accrual is one of those 2 adjustments we make to our statement of financial position. The other one being a prepayment. An accrual is where we bring into our statement of comprehensive income a cost that we expect to have incurred, but we've maybe not yet had the invoice, or we've not yet been had to pay it, but we expect to. We accrue for a future cost to bring it into this year's statement of comprehensive income. And it's like a liability. It's recognizing that we'll have to pay out something in the future, but it relates to this year. So yeah, 3 adjustments, as Cara is saying: prepayments, depreciation, and accruals. And we'll have a look at those later in this session. Now, don't worry about this. There's any of these terms as we go. Accruals, yeah, revo could appear. Yeah, it could be one of the adjustments that you might be asked to make in a question on the statement of both comprehensive income and financial position. Good stuff. Let's do another one of these. You get the idea. A bit easier once you've had a go at one. So here's part 1 of the question. This profitability ratio. Now think back to what we were doing right at the start of this session. Before I show you part 2, which of those 5 are impossible? The impossible 5. Which answers can't be right from the start of the question? This profitability ratio. What do we think? We don't have no idea, by the way, what grade boundaries are going to be, so it's really not worth asking them in the live chat, because no one knows. The grade boundaries are set depending on how you perform how everyone in total performs in the assessment. So don't worry about them. They are whatever they are. So what do we think? What is not possible? Which of those, therefore, isn't a profitability ratio? What do we think? Alexandra's gone for C1, C3, B3, and well, the live chat is now on fire. Lots of people have gone past, but I'm pretty sure that you were absolutely spot on. And just let me prove that actually these are the 5 that can't be correct, because they are not profitability ratios. These are the other 5 of the 9 ratios there, all listed. However, that leaves 4, and the second part of the question is, it shows how much is added to the cost of a product to determine the selling price. So which of those? Is it profit margin, markup, return on capital employed, or gross profit margin? What do you think? One of those 4 shows how much is added to the cost of a product to determine the selling price. And in fact, we're going to have a go at calculating it in a few short seconds. Cases in there with B1, followed very quickly by Eddie, Olivia, Callum. Superb, well done. Yeah, markup. And it's actually, markup is often the profitability ratio that students sometimes struggle with. Don't forget, you've got to know your formulae and always write the formula down and substitute the numbers in. But markup is sometimes the hardest one to sort of think about and calculate. So we'll have a go, shall we? So let's do a markup calculation. So here we go. Here's our first calculation challenge. And we're given some information about 2 fashion clothing shops. I've spent a long time thinking about what to call them. I called them Shop A and Shop B, and we're given some information there to enable us to work out which shop had the highest markup percentage. So here comes the clock. Have a go. Wow. Fantastic answers. And in particular, Nicole, shout out to you. You've actually added into the live chat your 2 markup percentages, and you are spot on, by the way, with those calculations. Lots of people in the live chat suggesting that it's Shop B that has lower sales and a lower gross profit, but it has a higher markup. Let's have a look, shall we? Why don't I get the answer appeared and displaying on the screen there? There it is. It is indeed, yeah, Shop B, a markup of 246.7% compared with Shop A, 180%. So don't forget, with markup, it's, if you like, it's the extra we add on top of the cost of our sales to get to the selling price. It's and the calculation. It's gross profit divided by cost of sales, and it's a measure of how much we try to make on each sale by marking up the cost to get to the price. So Shop B. Now it's quite interesting though, isn't it? Shop A has, let's say there were similar fashion shops selling similar products. Shop A has higher sales but a lower markup percentage, and that might be because their prices are lower. They're not trying to mark up their prices. Therefore, maybe more customers decide to buy from Shop A than Shop B. Maybe Shop B's prices are too high. Maybe they're trying to make too much profit on their fashion products. Who knows? I can't do anything about the light shining off my head. I thought I'd been in makeup, but I'll see if I can get the makeup team to come in and sort that out. For the next activity, anyway, back onto a profitability ratio that a lot of students sometimes struggle with. So over to you for another minute here. I've turned the scary music down a bit, but I think we should still have it in the background. We're on to return on capital employed. So we're given two pieces of information: sales of 780, expenses of £325,000. Now, assuming a gross profit margin of 60% and capital employed of 280,000, can you calculate, please, the return on capital employed? So you've got to do a couple of calculations here to get to the return on capital employed. Let's see who can get this first. Off you go. How we're getting on. So don't forget, with return on capital employed, we're looking for a percentage, and return on capital employed is calculated as the net profit for the year divided by capital employed. Well, we were given capital employed, so we know what the bottom bit is, 285,000, but we need to work out what the profit is. Well, profit is going to be gross profit less expenses, isn't it? And we were told that those sales of 780, they make a gross profit of 60%. So the calculation had a sort of couple of parts to it. The answer is 50.18%, I believe. We had to firstly work out what the gross profit was, which is £468,000. Take away those expenses, that gives us our profit of 143, and that's the thing that we divide by the capital employed. Don't forget, with return on capital employed, we always multiply by 100. We have to express all of our profit margins as percentages. Yeah, percentages. And normally with these kind of answers, I would round to 2 decimal places. If you're not told to, that's normally what I would do. Sometimes it's a nice round number. Sometimes it's not. So there we go. And I think lots of people got that. Hopefully that was you. Well done for getting 50.18%. Don't forget though, with all of these calculations, start with the formula, write the formula out, then substitute the numbers and show you working. So you'll still get credit, even if you maybe with a slip of the calculator or maybe using one wrong number, you don't get the full answer. You can still get some marks. So as Graham and Mike and Susan and the rest of the team always say on these live streams, always show you're working on your answer paper. Superb stuff. Let's do one more. This one is a break-even calculation. It wouldn't be a live stream without a quick break-even calculation. And this one is about a hairdresser, a gents hairdresser. So we're told about the selling price per haircut, £14. We're told about the variable cost per haircut, £8. Presumably the cost of the time of the hairdresser and the lotions and ointments, whatever that are used. And we're told about the fixed costs of the salon, £78,000. So over to you. 2 things to work out. Please work out the break-even output in terms of haircuts, and then the margin of safety if it does 18,000. Have a go. Another minute to have a go. Super stuff. Lots of correct answers here coming into the live chat. As I speak, Edward said it's 13,000 for the break-even output with a margin of safety of 5,000. Henrika said the same thing, but you've added units or haircuts at the end of your answer, which of course is quite important. Yes, I can see the live chat, by the way, in case anyone's asking. I try to respond as best I can to the questions about Unit 3 rather than some of the other questions. So well done. Yeah, now don't forget, this is a classic example of, particularly with break-even calculations, put the formula down, state the formula for break-even output. So I guess we'd use fixed costs divided by contribution per unit is probably the easiest way with this one. Then apply the numbers, substitute the numbers, do your calculations and show your answer. That way you got a chance of getting, even if you get the final answer wrong, you still get some marks for showing your workings and stating the formula. So there we go. Yeah, it was 13,000 haircuts. And because we told that the salon does 18,000, that's good news, isn't it? That means we're operating above the break-even output. That means 5,000. So margin of safety is actual volume or actual output less the break-even output. And there's our calculation. And all we did to work out the break-even output was we divided fixed costs by our contribution per haircut, in which case it's £6. £14 the selling price. I have to tell you this, I was quite upset a few weeks ago. I went to the hairdresser around the corner here and he cut my hair. Didn't take him long, to be fair. And he charged me £55. £55. And I said to him, £55 for a haircut? What's that for? And he said, sir, I had to charge you a search fee. So there we go. That's our break-even calculation. We've got a couple of activities left here. Why don't we do a quick chili quiz? Now, this is no calculations here. It's just you deciding which question you answer. And I've got a couple of these to have a go at. And they test some quite difficult, quite sort of, not unusual, but quite tricky areas of Unit 3 Business Finance. So the basic idea is I'm going to give you some time to have a look at the three questions there. You choose which, and you can choose none of them, of course. That's always your option. Or you can choose more than one. You can choose a mild option, which is quite a straightforward question. A spicy one, 2 marks, a bit harder. And the hot question, really hard. So have a go at choosing which of those. You can do more than one if you wish. Just type number 1, say, and your answer, or number 2. And anyway, you choose which ones you want. You can read the questions as well as I do. So why don't we start the clock and let's see what answers come in. Thanks for Graham playing the music in the background. Yeah, those were actually number 2 and number 3 were quite tricky, but we'll go through all 3. And it looks like most people have had a good go. Well, a lot of people had a go at answer 2 and 3. People are asking what are trade payables. Well, why don't we have a look at a suggested response to those questions, and it helps us explain what they are. So yeah, what does the trade payables days ratio show? Well, don't forget trade payables. It's a current liability in the statement of financial position. Trade payables is the value of what we owe as a business to other organisations, typically the suppliers. So we owe money to somebody, suppliers, for things they've provided for us. That's what trade payables are. And trade payables days shows how long on average it takes us to pay those amounts. So let's say it's 30 days. It means on average the supplier has to wait 30 days for us to pay them. And so that's what it is. The spicy question, 2 ways you could increase your trade payables days ratio. Well, there's 2 ways, aren't there? Firstly, you just don't pay them. You delay payment and don't tell them. And they'll start asking you, where's my money, please? That's one way. Probably not the best way, but lots of businesses do it. The second way is to actually communicate with the supplier and say, we'd like to be able to take longer, please. In other words, maybe moving from 30 days to 45 days. Please, would you let us pay our bills later? Maybe you've got a cash flow issue and you negotiate. And typically, most businesses will say, okay, yeah, all right then. Okay, as long as you pay me. So that's two ways you can do it. And the hot question there, a disadvantage of significantly increasing trade payables days, because that's the easy option, isn't it? Don't pay your suppliers. There's no cash going out if you don't pay anyone. But the problem with that is those suppliers may sniff a problem. Yeah, why aren't you paying me? Right, I either refuse to supply you any further until you pay me, or they may say, well, you can pay me later, but you're going to have to pay more for the products. You're going to have to increase. We're going to have to increase our prices for you. Therefore, you make a lower profit margin on your gross profit margin. So as a consequence of trying to pay people later. So that's the idea. That's the idea of trade payables. You get the idea with the chili quiz. What do we think? Should we do one more? We're almost there with this session. Let's do another. Now, this is, I think, really hard. These are, I would say, mild is 1.5 marks. Spicy is about 2.5. And hot is about 4 marks out of 4 marks, not 3. But anyway, have a go. Wow. Some fantastic answers coming into the live chat. This is really good. Although it's highlighted a confusion about invoice discounting, which we can sort out straight away. But well done. Some absolutely amazing answers, in particular to both 2 and 3. Well done on those. I'll just show you the answer, or my suggested answers for those 3. Just going back, though, on the trade payables question, somebody asked in live chat, is trade payables the same as trade credit? Kind of, but trade payables is specifically how much the business owes to its suppliers. Trade credit is more about allowing people to pay on credit or taking credit yourself. So that's why we specifically say trade payables. Anyway, back to this question. Invoice discounting isn't offering a discount on an invoice so your customers pay less. It's not about that. That's just called offering a discount. Invoice discounting, as somebody said, 2 or 3 people said, fantastic answer. It is using amounts owed to us by our customers, trade receivables, as security for a loan. So you basically get given a loan, and the security or the collateral is, if you don't pay the loan back, we have all your receivables. So that's what it is. It's quite a specific form of external finance. Well done, though. Well done. Well done if you knew that. That wasn't an easy one. Retained profits, an advantage and a disadvantage. Well, obviously retained profits, one of really the 2 main types of internal source of finance. It's cheap. The business can decide whether it keeps the profits in the business that it's earned. Disadvantage is if it's a company, a limited company, or even if it's not a limited company, the owners of the business may say, well, I want the profits. I want to spend them. I've got a holiday to pay for or an electric car to buy. So rather than keeping the profits in the business, they may say, well, I'd quite like to spend them, please. I've earned them. So that's the idea. And lastly, disadvantage of using venture capital. But don't forget, venture capital is a form of external finance. It's typically where an external investor invests in the business, and they'll always invest in a company, never in any other type of organization. And they will typically require 2 things. Firstly, a big shareholding, and secondly, control over many of the decisions and permissions about what the business is allowed to do. So that's a potential downside of venture capital, but still a very useful source of finance. Superb stuff. We're almost there. We're doing really, really well. Still loads of people with us, working hard. For the next 5 minutes or so, we've got a couple of 2 more activities. We'll just do a couple of calculations, and then we'll finish with a bubble quiz. And here we go. Just two calculations. And I mentioned adjustments earlier. There's accruals, prepayments and depreciation. Well, we'll just do a couple on these. Here's our first one. A business rents its premises at a cost of £44,000 per year. 4 months of that, though, relates to the next financial year. So how would you adjust for a prepayment for that in the accounts? Have a go. Only 30 seconds on that one. That was quick, wasn't it? What do you think? Any answers coming into the live chat? What would be the prepayment in the accounts? What do you think? Yeah, it's going to be 4 months, which is a third, isn't it? A third of 44. I can do maths. I was just trying to think. Let me work it out here. It's going to be a third of that should be next year. So it's 44 divided by... Actually, I'm just checking. I think, was it in my let me check my calculation on the screen here. Should have checked the answer that was going to come up. Actually, no, it's... sorry, it should have said 3 months of this has been paid, not 4 months. So it was actually 3 quarters, or 3/12. In other words, £11,000 is shown as a prepayment in the accounts. It should say 3 months has been paid next to related to the next financial year. So it's 1 quarter of the rent is next year's rent. Therefore, we show that as a current asset in the accounts. Prepayments, you're asking what prepayments and accruals are. So let's just quickly deal with that. Prepayments is where you spend money, but it actually relates to next year's costs. So we don't want to show the costs in this year. We want to show the fact that we've paid money, but it still has value for us next year. So typically prepayments include things like rent, mobile phone, contract bills, whatever, that kind of stuff. It's typically rent that you pay. Sometimes rates you're paying in advance, but it actually relates to next year. Whereas accruals are things that you adjust for that are relates to costs that are this year, but you haven't yet paid them. So you need to adjust for them, show them as a current liability. Okay, and our last calculation, we've got a couple of depreciation calculations here. So we're told the business owns a fleet of delivery vans with a historic cost of £575,000, and it's got a net book value of £400,000. Don't forget there's 2 methods of depreciation we can use. So have a go at either or both if you wish. So the straight line method at 10% depreciation. So I'll give you a clue. You basically take the historic cost and divide by 10. Or the reducing balance, and I'll let you have a go at that. I'm not going to tell you how to do that. Anyway, have a go at these. Have a go at these questions. And I can see lots of right answers coming into the live chat. James has gone for £55,500 for straight line and £40,000 for the reducing balance. And of course, the thing about depreciation is there is a difference between the numbers. However, it's not really about the fact that there's a difference. It's just that there are different ways of depreciation. So you just need to be able to work either or both out. So yeah, the straight line, it's really easy. We're told there's no resale value for these vehicles. So it's just, we spent £575,000 and we depreciate them over 10 years, 10% a year. We simply take the historic cost and divide it by, or multiply it by the depreciation rate, in this case, 10%. So the straight line is relatively easy. Reducing balance is just a different way of calculating depreciation. So each year we depreciate the assets, and what's left is what's known as the net book value. So that's the historic cost less the accumulated depreciation. So we were told that the assets have a net book value of £400,000, and all we do is we apply 10% to that. So it's 10% of the net book value each year. And the depreciation number is slightly different. But don't forget, this is a key point with depreciation, it doesn't involve cash. It has no impact on cash, no impact on the cash flow statement, no impact on cash flow forecast. It's irrelevant. It's just an accounting adjustment to reflect the fact that our tangible assets diminish or reduce in value. It's all it is, just an accounting adjustment. Therefore, it doesn't matter what the depreciation charge is really. Certainly from a cash point of view, it's just an adjustment. So there we go. Right, I think we're almost done. We've got about 3 or 4 minutes left. We're bang on time. We're going to finish with a quick bubble quiz. And 5 of these testing a variety of different parts of the business finance specification. So all you need to do in the live chat, that's it. We're done with calculations now. All you need to do is just put into the live chat the letters of the answers that you think are correct. So it could be one of them, it could be more than one, it could be all of them, or it could be none of them. Yeah? So just type the letters in and see how we go. We cover quite a lot with these 5 questions, actually. It's a nice way to finish off. So here's our first question. Which of these, if any, or all, are examples of revenue income? So we talked about capital income earlier in the session. Which of these are examples of revenue income? Just type the letters into the live chat, and then when we've had a few in there, we'll see how you get on. Christabella's first in, I think, or Bumblebee's also in the live chat first in. We've still got 600 plus people joining us on this session, so I won't necessarily be able to give you all a shout out, but those were the first 2 correct answers, along with Chantel, who's also, I think, got the answer right. So this is really good. Robbie 642 to be precise, has also got it correct, which is, the answer is A and D. So sales, revenue, isn't it? Income that goes into our statement of comprehensive income, as do commissions we receive. I don't know, for example, for selling something, a commission. Whereas a bank loan and owner's capital, those are very much capital income, aren't they? Not revenue income. We get the idea. Superb stuff. Next question. And we're back to one of our efficiency ratios here, a really important part of the specification. Which of those, if any, or all of them, or none of them, would increase trade receivables days? So is it using debt factoring to turn trade receivables into cash? Would allowing customers longer to pay the amounts they owe, would that do it? What about allowing more customers to pay using credit? Would that do it? What about decreasing the time we take to pay suppliers? So which of those, if any, would increase trade receivables days? One of our 3 efficiency ratios. Don't forget, trade receivables days is the average time our customers take to pay what they owe us if we're the business. So you want it to be as low as possible, really. Jack's saying B and C. Charlie's saying B and C with a question mark around D, which I think is interesting. Luke, though, is absolutely sure it's B and C, as is Kieran and Rahan. So let's have a look at the answer. It is indeed. Well done, B and C. So why is it not A? Well, debt factoring is a source of finance. It's not the same as invoice discounting, though it's similar. Debt factoring is where we sell our trade receivables to another business. They go collect it and they pay us some money, usually a percentage of what was owed. So that would actually reduce trade receivables days, wouldn't it? And similarly, taking less time to pay our suppliers, nothing to do with trade receivables days, it's trade payables days. Good stuff. 3 more to go. Which of these, somebody was asking earlier, what are internal and external sources of finance? Well, this will help us. This will help us, won't it? Which of those, if any, or none, or all, are internal sources of finance? Yeah, we'll be finishing time for the Seville. Is it? Oh, it's Frankfurt against Rangers in Seville, isn't it? That's right. There can only be one winner of that game, I think, and it's football. So what have we got here? Christabella's going A and B, as is Olivia. Alfie in agreement, as is Harry, and Josh 9000 has gone for A and B. It looks like most people, Brendan as well, Layla, is going for ABD. Let's have a look. It is A and B. Well done, yeah. By the way, not all of these answers are just two of them. It's random. The computer randomly throws these answers out. So yeah, sale of assets and retained profits. Well, we talked about retained profits earlier, and that is the main internal source of finance for most businesses. Sale of assets, hopefully retained profits, you get it every year, don't you? You make a profit, adds to your finance. Sale of assets, of course, is a one-off, isn't it? If you decide to sell, I don't know, some spare land, you can only do it once. So it tends to be a one-off. Leasing, where we gain access to cars and equipment from an external supplier, that's an external source, as is peer-to-peer lending, a form of crowdsourcing. And we've got two left, and that's it. Then we'll have to close this session unless we do the whole thing again. So which of these lines or rows or lines would appear, it's not a chart, but which of these lines would appear in a cash flow forecast? A, B, C, D, all of them, none of them, or some of them? What do you think? What do we think? Which of those might you expect to see as a line or row in a cash flow forecast? Bobby's saying all of them. In fact, Samantha's saying all. Just waiting for Olivia to reply. Olivia has said all, which must mean, given how well she's been doing on the this session so far tonight, it is well done. It is all of them, isn't it? So don't forget our cash flow forecast. It's a classic question. They maybe have a table, and you have to fill in a few gaps. So cash inflows, that's the total value of all the cash coming into the business. The closing balance is the difference between the net cash flow for the period and the opening balance. So therefore, net cash flows and opening balance also appear on a cash flow forecast. And I don't want you to get too upset about this. I know how you're feeling about it. Okay, we can do it all again, but this is the last question for tonight. I can't believe we've made it through to the last question, and I've only made one error, 1.5 errors on these questions. So that's the result for me. Which of these would decrease the break-even output of a business? We're about to break even again, and interpreting that break-even formula. There's an answer in the question, which is easier, personal finance. Oh, hang on. Oh, sorry, it's a question about Unit 2 and Unit 3. I was going to say, which is easier, personal finance or business finance? Well, clearly business finance has many more marks than personal finance, but every mark counts. What do we think? Mohammed's saying A, C, and D. Callum's going A, B, and D. Oh, we've got a variety of answers here. Jack's saying just C, as is Layla and Lily. Aha! Looks like we've saved the hardest question till last. Well, okay. The answer is, for those of you who got it right, and well done. Not everyone did, though. To be fair, Monya's just come in with the correct answer. The answer is just C. So to decrease the break-even output, that's good news, isn't it? It means we don't have to sell or make as many units to break even. It means that we should be able to get to profit quicker. Well, by lowering our fixed costs, that definitely does it, doesn't it? Because it means we don't have as many fixed costs to contribute from our contribution per unit. However, higher variable cost per unit, that will decrease our contribution per unit, as will a lower selling price per unit. So both of those two things will be bad news in terms of the break-even output. They would raise or increase the break-even output. And of course, clearly, so too would higher fixed costs. So actually, it was just lower fixed costs on that one. But apologies for putting a really tricky question in at the end. The rest of the questions, I'm sure you've done well on, as well as that one. And I think I'm done with that. So indeed I am. Yeah, so there we go. It's 55 minutes. So I was aiming for 45. 10 minutes of extra because we had so many people join us tonight. If you found that useful, hopefully you have. Give it a thumbs up on YouTube. As I say, if you're looking for some extra revision for personal finance and business finance, there are 2 videos on YouTube, but also on the tutor2u.net/live archive. If you go to tutor2u.net/live and go to the archive and use the BTEC National drop down, you'll be able to look at, I think there's 7 or 8 sessions we've done for Unit 3, including one on personal finance. We've done some as well on all the ratios, efficiency ratios, profitability ratios, and liquidity ratios. So if you want to do some practice on those, there's some questions there. So lots of questions. If you want to do some more of this kind of stuff, just work your way through them. If you want to do some more revision, if you want to put your feet up and enjoy the football, getting ready for tomorrow, that's just as good an idea, I reckon. And that's it from me and from our team for now. We wish you all the best in Unit 3. Have a go at every question. Keep to time, and you will be fine. I'm sure the exam will be fine. The assessment will be fine. And it won't be long before you're putting your feet up, looking forward to a well-earned, relaxing summer. So someone's saying, bye-bye, Baldy. I know who you're saying that to, and it's me. I'm wishing you all the best. I'll be keeping your fingers crossed. Everybody else here at TutorD will be too. And go well tomorrow. So cheers, everyone.